Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Kimball Electronics stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 544 million market cap. They're trading at $22 a share and they have 25 million shares outstanding. Kimball does electronics manufacturing, engineering, and supply chain support services to customers in the auto, medical, industrial, and public safety end markets. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 2021, but negative in 22 and 23. However, they have positive net income, so it looks like they're investing into CapEx. They did have a small positive in the trailing 12 months, only 7 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's pretty steady each year, $30 to $50 million. Really low margin, supermarket margins. 2 to 4%. Revenue is a sales for the company, and that grew a lot from 1.3 billion to 1.8 billion, but it has regressed in the trailing 12 months, a little under 1.8 billion. We estimated 4 years of future free cash flows. We also estimated the terminal value, it's all cash flow, past year 4, that's 1.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $950 million. We divide that by 25 million shares. And we get a calculated stock price of $39. They're trading at $22, so they're trading at a 43% discount. It's a pretty strong buy according to the model. This company looks like it has pretty solid numbers. And I wouldn't get too scared with the negative free cash flow in these years because they had positive net income. So I think the investment in CapEx will pay off and you'll see some nice growth in future years. There are 26 companies in the same industry as Kimball, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They do spend a good amount of CapEx, more than the average. A good debt to equity ratio. For every dollar of equity, they have 60 cents of debt. They do not pay a dividend. It looks like about half, or a little more than half the companies pay a dividend. They do generate positive free cash flow, which is better than the median. The median is negative. And they rank 17th in market cap of the 26 companies. They're trading at 1 times book value, 17 times earnings, which is probably the S&P average. Their price to free cash flow looks pretty weak at 78, but they have the best price of sales. When the price of sales is 0.3, that means their revenue is triple their market cap. This stock may be a screaming buy. And their 5-year annual revenue growth rate is 9%, which is between the median average. If you put $10,000 into this company 10 years ago, you would have done about the S&P average. A 10% annual return, 150% total return. So not too shabby. Let's take a look at their income statement. The top line is their revenue, and it's 425 million in the first quarter of 2024, down from 480 million. For the trailing 9 months, that's also down, a little under 1.3 billion. Last year, a little over 1.3 billion. I always like to understand how a company generates their revenue. Let's see if they give more detail on this number. We'll search the 425. Of the 425 million of revenue, 200 million is automotive, which is down. Medical, 113 million, also down. Industrial, also down. So that's not good. It's down in every category. An example of an industrial company is Whirlpool. Manufacturing companies are industrial. Revenue is down in the trailing 9 months for auto, but it's pretty much flat. Medical is down a lot, 377 million to 323 million. Industrial is up. That's the only category that's up. They give a little more detail on the decline in each category. Auto sales decreased 9%. That's due to an overall decrease in demand across most of their major customers. The decrease in medical is due to decreased sales with a large medical customer who is doing a recall. The cause of the recall is unrelated to the products they provided, so that's good. There is a bright spot in medical, a ramp up of certain programs and new product launches. So the decline would have been worse if it was not for this ramp up. Sales decreased 14% in the industrial industry, and that's due to lower demand with our climate control customers, as well as a program at our automation, test, and measurement business. There was an uptick in charging systems and public safety products. It looks like their biggest customer is Next Tier Automotive, 16% of their revenue. ZF is 12%. Next Tier is part of GM, and they're a major supplier in the auto industry. They specialize in the production of electric and hydraulic power steering systems, steering columns, intermediate shafts, driveline systems, and software for OEMs. They have 26 manufacturing plants, 4 technical and software centers. They have 13 customer service centers across North and South America, Europe, Asia, and Africa. They have big car customers, BMW, Ford, GM. So their net sales declined 12%, gross profit declined 22%, so their expenses are getting higher. Gross profit in the first quarter, $34 million, last year $43 million. Their margins went from 9% last year to 8%. SG&A is also up from 3.7 to 3.9%. And they had a goodwill impairment of $5.8 million this quarter. I can't really find out which company took the goodwill impairment. An asset impairment of $17 million. That means they wrote down the value of a fixed asset. Goodwill impairment is when you write down the value of a previous acquisition. An operating loss of $6 million. Last year was an operating gain of $25 million. Open orders are down 6% from last year, so the pipeline is getting smaller. Last year, 24.9 million shares outstanding. Now it's 25.1 million. So they did a little dilution. Let's look at a statement of cash flows, the trailing 9 months. So last year they had a cash outflow of $58 million. This year a cash inflow of $25 million. So that improved a lot. And they had lower net income in 2024. They had to add back $22 million of impairments. So their net income should have been $22 million higher. Impairments decrease your net income, but they don't affect cash flow. They're non-cash items. 2 really big differences. Accounts receivables, they had a cash outflow of $70 million last year, a cash inflow of $16 million this year. And accounts payable, a cash inflow of $37 million last year, a cash outflow of $70 million this year. Also inventory, there's a big swing, about $90 million. Last year was a cash outflow of $89 million. This year, a cash inflow of $1.9 million. In their investing section, they spent $37 million of CapEx. Last year was double that, $65 million. They added $38 million of debt from a revolving credit facility. If you want to learn more about the credit facilities, they list it right here. A credit facility is like a HELOC, a home equity line of credit. When you need money, you can just tap into that line. But when you borrow against the line, you have to pay the interest on it. But if you don't borrow, then you don't pay any interest. There might be some small fees though. So they paid down their primary facility. They have a secondary facility. They have $89 million outstanding. The footnote is number 2. So this is a $100 million facility with JP Morgan. So it's a line of credit they can borrow against. It's nice to have access to a line of credit in case you're short for payroll. Sometimes there's a timing difference of when you receive money from customers and when you have to pay money to your vendors or employees. You can see there's a fee of the unused principal, 30 basis points. So even if you don't borrow any money, you still have to pay 30 basis points. 100 basis points is 1%, so 30 basis points is 0.3%. So not a lot of interest, but you still have to pay money for not borrowing anything. And then when you do borrow, you pay on SOFR plus 175 basis points. So SOFR plus 1.75%. And there's other benchmarks too, Euribor, the ABR. Since they have factories all over the world, they have a facility in Thailand, because you want to keep your facility in the same currency. That's $10 million outstanding. A China facility, a Dutch facility, that's only $600,000, a Polish facility, and Vietnam. Because you don't want to just have a US facility, because you might lose money on the conversion. So you want to have one in each country. This section talks about their goodwill. The beginning balance of goodwill is $33 million. Then they took $21 million of impairments, so the net value is $12 million. Then they took that impairment this quarter of $5.8 million. Ending goodwill is $19 million minus $13 million, $6.2 million. So this $6.2 million is on their balance sheet. I'll show you. So it's right here, 6191. Goodwill, balance sheet, 3/31/2024. The $12 million from June 30th, you could find that in the beginning goodwill. Here's the footnote on goodwill. The beginning goodwill is $12 million, the ending goodwill is $6.2 million. Their EPS in the first quarter is negative 24 cents. They had a net loss. But those impairments should really be stripped out. So if you strip out the impairments, they would have a net profit. It's better to calculate EPS without the impairments or calculate the earnings per share based off of operating cash flow or operating income. Let's look at a company on Simply Wall Street. Its last price, $546 million market cap, flat the past week, down 19% in the past year. Could be a buying opportunity. They started trading in 2014, and that was the lowest point ever at $7.22. They hit $30 in November 2021, then came down and back up to $30 in July 2023. So the stock has gotten pushed down quite a bit since the third quarter of 2023. Look at Simply Wall Street, $84. They say it's 74% undervalued. 5 analysts priced this stock at $29. 2024 revenue forecast is $1.7 billion, next year $1.8 billion, then $1.85 billion. Free cash flow forecast this year is only $11 million, next year $34 million, after that $65 million. They were pretty much debt-free from 2013 to 2018. Then they added $127 million of debt in 2019. They brought it down to $60 million in 2021, but they must have done some acquisitions because it's gone up to $319 million currently. But their equity is always a lot higher than their debt, so they look pretty solid. The green line is their cash. They have $65 million of cash on that balance sheet. The CEO's salary is only $270,000. I like CEOs that get paid under $500,000. Total compensation $4.3 million, tenure as CEO 1.3 years. 79% of the company is owned by institutions, 19% by the general public, and 2% by insiders. Their biggest shareholder is BlackRock, then Dimensional Fund. Dimensional Fund is headquartered in Austin, Texas. The third is Vanguard, the New Jersey company Managed Account Advisors, then Royce, Ernst Partners, the Chicago company LSV, then Larson Financials, Pacific Ridge, Wells Fargo, Schwab, Envest, Foundry Partners. The employee count has gone up nicely from 3,500 to 7,900, and the ticker trades on the Nasdaq and Deutsche Börse. Let's read some news articles. EPS estimates fall by 33%. The 2024 revenue forecast decreased from $1.76 billion to $1.73 billion. EPS estimate was hammered from 162 to 109. That's why the stock is coming down a lot. Net income forecast to grow 30% next year versus 15% for the electronic industry as a whole. So that's a good sign. The price target is 29. This article is from May 15th, so the stock was 23 at a time. There's a new minor risk, earnings quality. The company has large one-off items impacting its financials. We saw the impairments when we looked at the income statement. Those one-off items were 38% of the size of their trailing 12 months earnings before tax. This is a minor risk. One-off items are income or expenses that a company does not expect to repeat in future periods, like goodwill impairments and asset impairments. Third quarter 2024, EPS and revenues miss analyst expectations. They had a 24-cent loss per share, we saw that earlier, down from a 66-cent profit. $425 million of revenue, down 12%, a net loss of $6 million. We know why EPS missed, but revenue missed too, 3.5%. And revenue is forecast to grow 4.1% per annum, compared to 6.2% for the US electronics industry. This is from January of this year. The stock has fallen 3.5% to $24. It's undervalued 22%. The fair value estimate is 31. Revenue up 15% over the last 3 years. Things look a bit rocky for the near future. Now, I'm not too sure about the stock. Let me know what you think in the comments. Leave a like, subscribe. Thanks for watching.